is every year, man. People buy and sell stocks, and then they get caught like not having put money back. You can also write off $3,000, Mika. Yes. So if you have $3,000 in losses, you can write that off. Capital losses, $3,000 on your losses in stocks. Yeah, 200 likes, man. I like that. I like that a lot. Yeah, max. Yeah, $3,000 is max you can write off, though. $3,000 is max you can write off. So you can hedge against a little bit, right? You can hedge against it a little bit. Sometimes at the end of the year, I will sometimes I will sell some of my stocks at a loss, just to get that $3,000. Again, man, sometimes it makes sense to do that. Sometimes it makes sense to do it. Not all the time. Sometimes it does make sense to get those benefits. Especially if I can just take an underperforming stock and I can roll that money from that underperforming stock over into a stock I actually believe in more and make more money there. Why not, right? I say why not to that. It's not called paper hands. It's called being smart hands. Smart hands, man. Yo, what's up, Flo Ron? How you doing, brother? Oh, you're doing good, my man. Hope you're doing well today, Flo. Yeah, I appreciate everybody being here, man. I also appreciate anybody that's hit the sub button today, anybody that's hit the like button. All those things definitely help out. Hey, we're having some good lessons today, dude, on corporate taxes and how the Fed could move markets. Dude. This is stuff that gets my brain moving. Nerd hands, man. Nerd hands, dude. Hey, sometimes you gotta move some capital, man, to be smart. Through the pandemic, you can claim the same loss. Yeah, it's true too. Raw. There's a lot of stuff that changed a little bit here and there, man. Due to all that. Yeah, 30 minutes, man. 30 minutes. Sure, minutes. Let's go to on the YouTube right now. Wait a second. I think they're going to be streaming it live on their YouTube as well. I have it up either way. I have both of them up either way. $30-minute boys, J-Pal. Pow. 30 minutes on the J-Pals. That's a one day. I was like, what is going on here? Yeah, Neo had a pretty good buy right there, though. Right? He shot up pretty good little cents. Now people are selling again. This is what's happening, guys. I'm telling you, I told you guys, we might see a spike in stocks right before J-Pal comes out and talks. Just to see maybe another sell-off again. Everything's shooting up a little right now. I'm telling you, man. It's the reason why That's the reason why my title is called "Stock Market Swings Today?" ? Right here, dude. You can see a lot of buys, a lot of sells, right before J-Pal starts coming out. What will the fox say? What will the fox say?
Here, talking about those famous dots. Where are the Fed officials when it comes to the outlook for rates? 4 officials now see 2022 rate hikes. That's up from 1 in the prior. That is the December projection. 7 officials see 2023 rate hikes. That's up from 5. But still, there's no change in the meeting because only a small number continue to call for those rates. Let's get to the statement now. The Fed saying, or a new change in the statement, that economic and employment indicators have turned up recently, though sectors affected by the pandemic.
Not the worst news.
Fed continues to
Wasn't
see
a
inflation
lot.
running below 2%. That is its 2% target, and using some boilerplate language from
Inflation was below 2 is good.
Using its full range of tools, the path of the economy depends on the course of the virus, and policy will remain accommodative until the federal.
This isn't bad news so far on this stuff.
Asset purchases will continue as it said in the past until substantial further progress has been made. The decision was unanimous. Tyler.
All right, let's follow up with a couple of questions. On inflation, they see for the full year, even though it's running below 2% now for the full year of this year, 2.4% inflation, 4.5% unemployment this year, dipping to 3.5% by 2023. How close are they really, and what is the implication for policy? How close are they really to that dual mandate imperative that they want to hit, which is inflation of 2% or maybe a little above, and full unemployment, which is, I don't know what it is, 3.5%, 4%?
Well, I have to amend your question, if you will, Tyler, with all due respect.
Sure.
Remember, the goal is to aim for inflation above 2%.
Steve still fully don't get it.
So maybe it hits that inflation goal, though it does go back down.
Boost GDP forecast is 6.5% from 4.2.
2022.
It's not the best.
And it gets to 3.5% unemployment. Now, I have to take a guess or a stab and say that's their goal, right? Getting back to the prior low unemployment rate. So that doesn't happen until 2023. So the dual mandate, if you take these literally and you make some assumptions about where their goals are numerically, they don't hit the dual mandate until 2023, and they don't
start seeing some sell-offs a little bit.
Raising rates then. The median forecast
See what happens right here.
rate in 2023 remains 0.1%. Their longer one forecast, their longer one goal,
let's look at this real quick,
is 2.5% for the funds rate.
So let me ask you a quick follow-up here. You said that 4 of the members expect rate hikes, the first rate hike to be in 2022 next year.
That's not
and
good.
7 are predicting it for 2023.
Not good.
How big a difference is that from
Not
just
crazy.
the last meeting? I think you said
I mean, that's
only
crazy.
one who was going to go on the record and say rate hikes were coming in 2023 or 2022. I forgot.
2022. I've got to look at 2 separate documents here, Tyler, if you don't mind. I will tell you exactly what the story is. So there was one prediction for a rate hike in 2022. That's now 4.
That's
so
now 4.
3 became brought it forward, and there were 5 forecasts for 2023 rate hikes. These are back in December, obviously the last projections, and now there's 7. So obviously
how big a change is that? Put that into a context. Is that more than people expected? Roughly what you might have expected is, and how is it fit in historically?
I think it's terrible.
I think it's in line. Look, Tyler, during the pandemic and in the middle of the pandemic, we had nothing but doves on the FOMC panel. I think now, David Kelly was talking before about, is it 9-9? I think now what we're seeing here is a little bit of kind of, separation back to maybe some traditional stances that some of these FOMC members took, which is you're going to have some members who are going to be more hawkish. They're going to want to move a little faster. Some are going to be a little more dovish. I think when you have situations like that, well, you ask the most important question, where's the chairman? I think the chairman right now is very dovish when it comes to wanting to keep interest rates down, keep policy in place until they achieve their dual mandate. It's significant. There's a discussion obviously going on. There are differences of opinion, but when the median doesn't change, it tells you that the full weight of the board remains behind this dovish policy.
Hang on a second, guys. I'm trying to find something real quick too.
Courtney.
Thank you, Tyler. Steve, stick around with us. I want to get back to our panel for the reaction. Mona, there's a lot to work with here. Where do you want to go? You want to talk about the inflation expectations or the policy to remain accommodative? I guess that's not a super surprise.
Let's bring this chart up real quick. Chad. I need to find it real quick. Go to Feds. Let me bring this up. We can look at this. We can look at the same app we looked at a minute ago, but we can compare the two. And we can see the differences. We can see differences, man. We'll leave this one up. A Fed Reserve. I don't see chat right now, so I love you guys, but I'm also bringing up the plot charts. It just got released. Federal Reserve, where's your plot charts? Here they are. All right. Let me pull up chat again. I have chat. There we go. Sorry, guys. I'm bringing this up real quick. This is a new plot chart. You can look at last plot chart versus this plot chart, right? But honestly, this isn't terrible news, though, right? Let's see. What is their Federal Reserve 2022? Let's see. GDP is 2025. And you can definitely see the difference. Now, again, a lot of people aren't going to see this until, a little bit later, too. All right. If we bring this up real quick. This right here is the new plot chart, right? This is the old plot chart. So you see this old plot chart? Let me get this one back up, okay? You see 2021 in the old plot chart said 4.2% GDP. 4.2% GDP. In 2022 had 3.2. They still pretty much made 2022 They made a 3.3. Not too big difference. In 2021 they made a 6.5 though. The 6.5 GDP for 2021, which obviously you're gonna have a higher rate because 2020 was shut down. So in 2021 they're expecting more people to be out doing things. So obviously you're gonna have a higher uprise really quick. 2022 it started settling back down though, kind of like where they thought right here. 2022 they said 3.2. Now it says 3.3. 2023 says 2.4. And they're saying 2022 is 2.2. Longer run 1.8. 1.8 is there. Unemployment rate. What is that unemployment rate? It said 5.0%. Now they're saying 4.5. 4.5 is not bad. 4.5 is not bad. I thought under 4% would be not good because obviously I would rather people not be unemployed, but that would have scared investors, spooked them more, thinking they're going to raise rates higher. You had 4.5 for 2021 versus they're projecting 5.0 for 2021. Inflation rates they had 1.8 last chart for PC inflation rates. Now they're saying 2.4, which is kind of in line with what I kind of thought. Honestly, I thought around 2.0-ish or a little bit maybe above. Obviously, you got people going out and spending a lot of money that obviously last year, so 2.4 is not terrible either. Those right there aren't bad numbers. The GDP being at 6.5 is probably not the best thing. People are thinking over 6 would be not the best in terms of like people looking at it, but 0.5 over is I don't think that's like sickening news. You can kind of see some of the market responding to some of these numbers. Which we don't have Jerome Powell out yet either, right? Let's pull down to the plot chart. Look at the plot chart. Okay, here's the plot chart. They made an arrow. Do you think that was on purpose, chat? Okay, here's the old plot chart. Down here. Here's the old plot chart. So they had 3 down here in 2023. Obviously, they had 5 altogether out of line here, right? They had 1 at 2022. You bring this up, they have 4 now at 2022 instead of 1 at 2022. It's not the best news in the world, right? But it's still lower than I was thinking would hurt a lot. Now, I think if we would have seen like 6, we would have seen like 6 here, that would have really been not good. We had we had 5, 6, 7 here. They had 5 before. So only having 2 more there is not terrible either. I thought if they would have had like 9 here, that'd have been really bad. But they don't have like 9 there, right? It's okay for this. The longer run's fine, right? Anywhere from 3 to 2%. That's it's normal, right? That's where we would be if the economy wasn't like in a tatters. But it's honestly not bad news. Honestly, not bad news, but I'm also kind of scared that this could be Fugazi in the market right now. And then when Jay Powell comes out and talks, the market might go down. We'll see, man. We'll see. I don't think there's anything bad there, though. I don't see anything like really bad. To be honest with you. Let's take a look at this chart real quick. You see this last time, which is the change in the real GDP, unemployment rate, right, going down. It's not bad either. Change in GDP going down, obviously unemployment rate doing about the same. So The unemployment rate percentage 2020 obviously was high. Then they have the blocks going forward, right? Your blocks right here going forward. Same thing here. You have blocks going forward. I don't see anything bad there. But I'm also still kind of cautious though that J-Pal's going to come out and like it's going to be like nah. But I mean, right now the market's acting good for the most part. There's definitely some stocks going a little bit cray, but I don't see anything there that's like bad. I think there's really bad. What independent day trader? Does that mean I am unemployed? Wait a second. I'm a full-time independent day trader. Does that mean you're unemployed? No, I don't think that means you're unemployed. If you're making money through day trading, I don't think that means you're unemployed. I mean, you're a day trader. You're taxed at the government's going to tax you as a day trader, right? So you're going to be. It's pretty much your employment. Pretty much your employment, right? There's a lot of big buys coming in right now, though. But I got an indicator that tells me like when buys and stuff are coming. There's a lot of them. So lots of buys. That's a good positive note as well. Oh, let's see. But lately though, like employment stats. I don't know. Honestly, I'm guessing the government wouldn't count you as unemployed, though. They would count you as a day trader. Make some money this year, wait everyone to freak out next year and buy. I mean, yeah, obviously. I don't think there's anything bad there. I don't think there was anything like super bad there. And any of the numbers I just read were like terrible. Could have been way worse. Way worse. And I think it's the reason why you've seen the market kind of respond right there pretty good with it. Good news, Joy? I think it's pretty good news, man. I don't think it's anything bad. Honestly. I don't think there was anything bad that was like super bad that was just like, you know what I mean? Obviously the plot chart was had more people like in 2023 and 2022 with wanting to raise rates. That's never good. That's never good, right? But I mean, it wasn't like there was like a ton of them on there, right? It wasn't like so many dots that was just like overwhelming there. If you're actually looking for unemployment and don't have a job, you're not counted. Yeah, I was going to say you're not really counted as unemployment to the government unless you're like looking for a job and getting unemployment. So there's a lot. Unemployment numbers are probably higher maybe than they seem because there's a lot of people that don't have unemployment. A lot of people that don't haven't even applied for unemployment or applied for unemployment didn't even get it. Unemployment numbers are probably a little bit higher than you would expect. Neo's green. A lot of things are green right now, which is good. Which is good. And I figured if we got some decent news, we'd see like some pretty good gains right now. I'm still kind of scared, man. I'm still kind of scared. Like we don't have the full story until J-Pal talks. Right? We don't have the full story until he talks. The plot lines aren't bad. They're a little bit worse than they were before, right? You had how much was it? Like. You had 5 last time saying they want to raise the interest rates in 2023. This time you had 7 saying they want to raise interest rates in 2023. Last time you said you only have 1 person say 2022 they want to raise interest rates. This time you had 4 people, though, say they want to raise interest rates. So there's not the best news, right? It's not like the world. But there's still a majority that said they didn't want to raise rates until 2024 and after. Majority is still there. You know, your GDPs were up, 6.5. Obviously, anything over 6 is not good to be looking at. But 6.5 is not much over 6. It's, a half percentage point. They were projected last time to be at 4.2. So you're still up quite a bit from that 4.2 to 6.5. Unemployment numbers didn't drop drastically. I thought under 4%. On unemployment numbers would have been bad. We only dropped to 4.5 from the old estimate of 5.0. So having a 0.5% drop back in that estimate, drop to 4.5 from the old estimate of 5.0. So having a 0.5% drop back in that estimate's not bad either. It's not like it's in the world there. So I don't think there's anything there that was like bad, man. Honestly. Nitro, dude. What's up with the AMC share recount? Whenever they do the recount, what day is it? You guys know the day. I don't remember off the top of my head, but they're supposed to be doing a share recount still. Yes. That doesn't mean they have to count every single one. That's what people really don't get at. But they'll probably have like a small sampling at start as like a trial, like a phase. They'll go through and see how far those numbers are off, and then if they're like crazy off, and then they would probably do a recount of all. Kind of like if you have like if you had like a recount of like an election or something, pretty much recounting votes. This first small batch is really off. You're gonna definitely do it then. Go to the bathroom and come back to some stuff. What happened, man? I thought he speaks in 10 minutes. He speaks in 10 minutes, but you remember. These things get put out to media sooner than that. So these things get put out sooner. So we have numbers. We have the numbers there, right?
That's another clue as to what's going on because the short end, of course, is hooked into the Fed most closely. If you look at 10s, what's fascinating here is it was at 166. The high was 168. You can see it's contained. But don't get too excited about contained because it didn't give up any ground. But here's the one you should be watching, the 30-year bond. The longest maturity, which is at the highest intraday yields, going all the way back to the...
It could be a lot worse, honestly, Speedy. That's what I'm trying to say.
2019, and if you look at it, it took out its earlier intraday high. A fresh new cycle intraday high, and that's pretty much
somewhere around
the dollar index and the yield curve. Dubs continue and investors continue to fade that the Fed can keep it off control. Courtney and Tyler, back to you.
Rick, thank you very much. And we've got some breaking news now out of Washington. Let's go to Elon Moy for the details. Elon.
Tyler, the one month from April 15th to May 15th. This comes as the agency faced growing pressure from both Democrats and Republicans to give people a little more breathing room to file their taxes in the middle of a very complicated financial year and also allow the agency some time to
it could happen, Trebek. Still, is what I'm saying.
Rescue plan, sending out those stimulus checks, giving out expanded child tax credits, treating unemployment insurance a little bit differently. So Americans will now have more time to file their taxes. The deadline now, May 15th. The Treasury Department separately also coming under fire from Ohio, which is now suing the agency over some of the limitations around state taxation that come as part of the aid given to states in that rescue plan. There are a number of states that have sent a letter to the Treasury Department, 21 states, calling for them to reconsider some of the strings that come attached to that COVID relief. We'll see where that one goes as well. Guys?
So what is, explain to me one more time, Elon, what the state's beef is with the American Rescue Plan?
Well, as far as I can understand it, and I haven't read Ohio's
I hate politics
all the way through, but what states are concerned about is that they were prevented from being able to cut state taxes if they receive money from the Coronavirus Relief Fund. They are saying that's overreach by the federal government and an unconstitutional intrusion into their powers. And so now they are filing suit or threatening to file suit against the Treasury Department in order to prevent that from happening. We'll see what the courts decide.
Yeah, well, that's really a court issue, not so much a legislative issue, it would appear. But that is me sitting here, not someone as knowledgeable as you are about the ways of D.C. All right, Court, take it away.
Thank you very much, Tyler. Well, coming up, we are less than 10 minutes away from Fed Chair Powell's press conference.
Please, 10 minutes, Chad.
Ask a former Fed governor what Powell needs to say to this latest decision. Stick with us. We'll be right back.
Come on, Oh, we should have had it there. I don't think it's in here anymore. I haven't seen it either. I had it somewhere.
We see harnessing.
All right, chat. We got 10 minutes, man. 10 minutes. Don't just go YOLO? Yeah, I don't know, man. It depends. Like I said, it all depends on like what Jay Powell is talking and how he says, man, how the market, receives that. Just because we got the stuff in doesn't mean everything. It's either a countdown to liftoff or a countdown to SpaceX launch. Yo, Speedy Lamel, bro. We'll see what happens. I mean, obviously, like, the plot chart, wasn't the best plot chart in the world. But it also wasn't, like, so bad that I'm, like, super worried about it. I think it all obviously lines on, what he's saying during this talk. Definitely waiting. If you guys have it, make sure you guys hit the like button below. Let's get the 200 likes, chat. Let's go. Let's go, baby. Nobody knows yet, honestly, Job. I mean, again, some of those numbers aren't bad in there. But there's definitely some numbers that, like, kind of concern me a little bit. GDPs, obviously, I feel like if unemployment rates were forecast to be under 4%, that would also concern me a little bit more for bigger investors to pull out some. They're definitely like right on the teeter-totter, man. It's right on the teeter-totter. It's the reason why I'm like, I'm just going to wait till he talks. I feel like it could go either way. That's the problem. Like, I'm on that 50-50. I hope he doesn't see a shadow, Reezer. Yo, me and you both, man. Me and you both. That's what I'm saying. I'm like, come on, man. Come on. Give me this. Get there, bro. Give me this. I want to see it. They're live right now already, but that's that music. All right, Chad. They're live. Oh. We'll I'll try to treasure this down a little bit. That way, I think of the whole screen, nothing but the screen. Oh, there we go. I mean, that there wouldn't be that big of a deal. I guess it would. Right? We can just make it smaller. Hello, YouTube. How you doing? Right there shouldn't be that bad. That shouldn't be that bad, brother. Whee! Tell us good news, please, good sir. Tell us all the good news you have today. Oh, man. Bless us, all Holy One. Pretty much, man, at this point. All right. We'll have that right there. I'll have it pulled up when he goes live, right? I'll pull it up when he goes live. This makeup better be dang, dude. I hope, bro. Oh, man.
I think that held them back a little bit. So I think there's a little bit more danger that they go too slow. And one of the main reasons is that they are
we sacrificing anyone today, dude? I guess today's Brandon's turn, man. Brandon's got to get sacrificed today, dude.
And they believe it's going to overshoot. They've never kept the funds rate
it was kind of like that buy email I was talking about a minute ago, like earlier today. I said right before right before he goes live, Jay Powell goes live, we could see a big buy and then a sell off, right? You can see a big buy up and then sell offs again.
Interest rates where they are, right, Larry?
Kind of what happened.
Can you leave them right where they are, despite that it may overshoot that goal?
Right. So we're talking about 2023. Yes. So keep them the same until it's at 2% for a year. And they expect it to overshoot in the following years. So,
Larry,
go ahead.
Continue your thought, Larry.
So
agreed.
And
No news is good news. I mean, it wasn't like bad news in those plot charts and stuff, but it definitely wasn't like the best either.
So we'll have to see. 2023 is a long way off.
But hopefully it doesn't, and hopefully it goes up, right? That's the good news we hope for.
And we shouldn't pay all that.
Yo, let's get the 200 likes, by the way, chat. Let's go, dude. 200, we got this. If you're not a sub, make sure you guys hit the sub button as well.
What about a taper timeline? Is it still appropriate for the Fed to be making the purchases at the level at which they are and for the foreseeable future? When does Powell need to begin to forecast that a little bit more clearly for the markets?
Well, it's certainly not for the foreseeable future.
You're not going to see that.
About when they're going to need to taper. It's where there's significant progress.
He's supposed to be out any minute. I'm over here like switching back and forth, seeing if he's out yet. He's not out yet, though.
A lot of interesting discussion within the committee. So I think that if you look at them, they have a 4.5% unemployment rate.
420 blazing.
I think that's not quite low enough. I think it's going to have to be closer to 4.25.
A few donos today as well. I appreciate it. Those things help me continue to be able to do these things. So I appreciate it as well.
Beyond this year, in the first quarter or most second quarter of next year.
So one quick question before we have to leave you. Did I hear you correctly then that you think that the earliest they will begin tapering those asset purchases is next year? And when might they start to signal that?
The earliest is December. I think we're at December. But that forecast suggests to me that it's more likely to be in early next year.
All right, Governor Meyer, thank you very much for being with us.
Good afternoon.
Always good to see you. Thank you.
I would like to start by noting that it has been a full year
Powell,
since the pandemic
said
arrived
at the
with
top of the
force on our
broadcast that
shores.
this meeting feels
Looking
a
back,
little-
it was clear that addressing a fast-moving global pandemic would be plainly and primarily the realm of healthcare providers and experts. And we are grateful to them and to all the essential workers for their service and sacrifice. The danger to the U.S. economy was also clear. Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. Here at the Federal Reserve, we rapidly deployed. We are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. The economic fallout has been real and widespread, but with the benefit of perspective, we can say that some of the very worst economic outcomes have been avoided by swift and forceful action from Congress, from across government, and in cities and towns across the country. More people help. We welcome these positive developments. No one should be complacent. At the Fed, we will continue to provide the economy the support that it needs for as long as it takes. Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy can significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due importantly to unprecedented fiscal and monetary policy actions, which have provided essential support to households, businesses, and communities. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up notably since our December summary of economic projections. In commenting on the stronger outlook, participants noted progress on vaccinations as well as recent fiscal policy. As with overall economic activity, conditions in the labor market have turned up recently. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that were lost in December and January. Nonetheless, employment in this sector is more than 3 million below its level at the onset of the pandemic. For the economy as a whole, employment is 9.5 million below its pre-pandemic level. The unemployment rate remains elevated at 6.2% in February. This figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 4.5% at the end of this year and moves down to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Overall inflation remains below our 2% longer run objective. Over the next few months, 12-month measures of inflation will move up as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation. The median inflation projection of FOMC participants is 2.4% this year and declines to 2% next year before moving back up by the end of 2023. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2%, as seems likely to occur this year, would not meet this standard. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month.
That's good.
Until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Our forward guidance for the federal funds rate, along with our balance sheet guidance, will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and ties the path of the federal funds rate and the balance sheet to progress toward reaching our employment and inflation goals. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so.
Brendan.
To conclude, We understand that our actions affect communities, families, and businesses across the country.
Say support.
Everything we do is in service to our public mission.
Yeah, yeah.
We are committed to using our full range of tools to support the economy
Yes,
and to help assure that the recovery from this difficult period will be as robust as possible.
Yes. Keep saying.
Thank you. I look forward to your questions.
All right, we got questions, Chad. Questions. Here's where you find out. More stuff.
Howard from Reuters.
Hi, Chair Powell, and thanks for that. So, could you talk us through how the forecasts for 2021 map into the substantial further progress definition? 2.4% inflation. I understand that's considered transitory. That still seems like some progress there. 4.5% unemployment. Is it time to start talking about tapering yet?
No, don't say
Not
it
yet.
Yeah, there you go.
So,
good answer.
As you pointed out, we've said that we would continue asset purchases at this pace until we see substantial further progress, and that's actual progress, not forecast progress. So, and that's a difference from our past approach. So, and what we mean by that is pretty straightforward. It is we'll want to see that that the labor markets have moved, labor market conditions have moved, have made substantial progress toward maximum employment